Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Wednesday, March 18th, 2026, and today's tape felt like a liquidation-style, risk-off wave. The important part? The megacaps did not save you this time. They sank with everything else, and the ugliest pockets were payments and healthcare, enough to make this feel like real de-risking, not some tidy sector rotation. Now look at the S&P 500 heatmap. It's a sea of red, most tiles negative, and it's not just the small stuff. The biggest tech blocks were down too: Apple, Microsoft, Nvidia, Alphabet, Meta, Amazon, Tesla. That matters, because it strips away the usual illusion of strength from the megacaps. This looked like active distribution, not a sleepy pullback. So what's the money doing? It didn't look like a clean sell growth, buy defensives day. Discretionary was heavy, but staples didn't trade like a bunker either. Healthcare got tagged, helped by a big AbbVie downdraft. And inside financials, the real tell was payments. Visa and Mastercard were outsized laggards. On the other side, defense and select industrials looked like relative safe harbors, and energy was comparatively resilient, even when it wasn't fully green. Zooming out, the risk posture looked worse than just equities. Silver traded heavy, and crypto beta was for sale too. When those don't hedge, it reinforces the idea this was broad risk reduction. And heading into the next open, traders are left with one practical question: was today a one-day flush, or the start of follow-through degrossing? One piece of desk chatter stood out today: renewed talk about card network disruption and fee pressure. Merchants, fintech, stablecoin rails, even AI-enabled payment routing. That story has popped up before during sharp air pockets in the card networks, and it was cited again as Visa and Mastercard underperformed. Important caveat here: this is market chatter, not a confirmed single-cause explanation for the move. Tensions hit a breaking point in Washington today as the Federal Reserve held interest rates steady at 3.5 to 3.75%. They did it despite relentless pressure from President Trump for a cut to jumpstart the economy. But for Chair Jerome Powell, one of his final acts before stepping down this May, the math just didn't add up. The elephant in the room is the escalating Iran war. After the recent attacks on the South Pars gas field, crude oil has surged toward $100 a barrel, raising real fears of an inflation spiral the Fed is legally bound to contain. Yes, the job market is cooling, but the risk of wartime inflation pushed a nearly unanimous board to play it safe. Markets are now bracing for a higher-for-longer reality, with many expecting just one rate cut for the rest of 2026. The conflict in the Middle East just entered a new phase: full-on economic warfare. In a large coordinated strike backed by the Trump administration, Israeli forces hit the South Pars gas field, the crown jewel of Iranian energy. With about 70% of Iran's domestic gas cut off, the regional fallout is immediate. Gas flows to Iraq have stopped, and Qatar has issued a sharp condemnation as the shared field burns. On the water, it's even worse. Crude oil has ripped past $108 a barrel, as the Strait of Hormuz is effectively closed to commercial traffic. With senior Iranian officials like Intelligence Minister Esmail Khatib confirmed dead in overnight strikes. Tehran is now warning neighboring Gulf states that their energy hubs are the next, quote, legitimate targets, end quote, for retaliation. While fires burn in the Gulf, a different kind of fire is hitting Western alliances. President Trump's call for NATO and Asian allies to help patrol the Strait of Hormuz has slammed into a diplomatic brick wall. From London to Berlin, the answer has been a firm no. The UK is tightening US base access, and Germany is saying, this is not our war. The rejection triggered a scorched earth response from the Oval Office. President Trump pivoted, branding NATO a one-way street and insisting the US doesn't need help from anyone. But on the water, the reality is very different. With no international coalition in sight, shipping traffic has collapsed to near zero. As maritime insurance disappears, the world's key energy artery stays paralyzed, leaving the US to face a global energy crunch and the Iranian threat essentially on its own. Mastercard, MA, was one of the cleanest stress points on the tape, down about 3.6%. What made it stand out wasn't just that it was red, it was how badly it lagged inside financials. Traders linked part of that to the recurring disruption and fee pressure story around payment rails. Whether or not that chatter explains the whole move, Mastercard's downside mattered because it hit a quality compounder, not some fringe cyclical. ABBV, ABBV, was a standout in healthcare for the wrong reason, down more than 5%. The move looked like a stock-specific air pocket in an already red tape, and the notes flagged no clear, same-day headline to confirm it. Market impact is straightforward. When a megacap healthcare bellwether breaks like that, it undermines the whole idea that defensives are getting a safe haven bid. Microsoft MSFT slipped about 1.9%. There was no confirmed stock-specific headline here. This looked like pure mega-cap de-risking. And Microsoft matters, because it's one of the core quality growth anchors in the market. When it trades down with the rest of the tape, it removes a key stabilizer for the Nasdaq complex. Amazon, AMZN, fell about 2.5%, as consumer discretionary was one of the heavier parts of the board. The move read like broad risk-off selling, with no company-specific headline confirmed. Still, Amazon's tape matters, because it's both a major index weight and a key read-through on discretionary risk appetite on days like this. AMD finished green, up about 1.6% in a session where much of semis and the mega-cap backdrop were red. The read was simple, idiosyncratic relative strength with no single confirmed headline driving it. On a de-risking day, a lone green semi is exactly the kind of print tape readers log as potential leadership when the selling finally cools. The silver ETF SLV dropped about 4.1%. The notes pointed to ongoing precious metals volatility and unwind dynamics after earlier extreme moves in silver. The takeaway for today's tape: metals did not behave like a clean hedge. That cross-asset weakness reinforced the liquidation-style feel, instead of giving the market a safety valve. Looking ahead, Thursday, March 19th, doesn't bring big U.S. macro catalysts on the calendar, so the market may stay very tape-driven. Key tells from here: do the generals like Microsoft stabilize, and does discretionary via Amazon stop leaking? Then the damage check in Mastercard and AbbVie. Do those air pockets find real sponsorship or keep dragging? And if there's a bounce attempt, AMD's relative strength becomes a quick test. Does it hold up, or just fade with the tape? Bottom line, this was not a clean rotation. It was broad selling, with the generals down, so it felt real. Payments cracking and AbbVie's air pocket added pressure, while defense and energy were more about downlist than true risk on. Into the next session, the focus is simple. Does breadth improve, and does leadership reappear, or does de-risking just keep grinding? Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.